Good morning. How's it going? Happy Monday. This is the 0DTE morning market analysis. And man, it is dark in here. You probably can't see it, but I can. I have to turn on the lights. Just give me a second here. Studio direction. I'm all by myself, so I can't yell to the grip handler over there, but here we go. Whoa! Calm down. There we go. Bring it down. All right. We're good. So now you can see all the pores in my face. It's a happy Monday morning, as I said. It is unbelievably cold for March 3rd here in the Northeast. I think it was only 12 degrees this morning. Really looking forward to the end of winter. Anyways, today's market focus is going to be on volatility. And while it might not seem like a big deal right now, there are underpinnings that I want to talk about, and we'll take that on very soon. But first, we're going to get into our market analysis, where we determine our situational analysis, what we're going to do, how we're going to trade this coming day. And the volatility report that I'm going to talk about will kind of set us up for our expectations with this coming week and in the future. All right. So we trade out of the money butterflies to put on an asymmetric trade with very small risk, large potential reward. And we do that on the 0DTE event, trading things like the SPX, the NDX, as well as the futures for those indexes. And, well, instead of me just keep on blabbling around, let's just get to it, all right? Let's see. Let's go to the charts. There we go. So here's the VIX. And I've added an indicator on here just to make my point. It's called the realized volatility. And you can see over the last few days, it's kind of interesting. So the last few days, not the last few days, but the last few months anyways, it's definitely been a sea change from what we experienced in mid-2023 through almost to mid-2024. And some brief periods where we came back down below into the zombie land. But you can see there's a definite change where we've hung out in the lower third or lower half of the Goldilocks zone for the past several months. And that's significant. All right, that's very significant. It means that realized volatility, or RV, has been sitting at a heightened level over the past 30 trading days for sure, and particularly before that. And this represents an annualized standard deviation of daily price movements, and it translates to daily swings of about 1.13%. So normally we're under 1%, all right? But now lately we've been a little bit over, and we've also been experiencing intraday swings, as you've probably noticed, that have come into play. And sometimes, you'll choose a bearish or a bullish direction, and then it just totally reverses, and then totally reverses again, which is awesome. Compared to our long-term average, which is approximately 30% under that. So in other words, we're experiencing about 30% more intraday swings and volatility in price movement than the expected move might lead you to believe. And this is all good, by the way. If you're not a 0DTE trader, you're going, "Oh my God, what do I do?" We love this. And it's really reflected in the morning when we do our big ass fly assessment. We are looking at a big ass fly, and it's sitting there at 20 or less, and we're going, "Hey, what the hell? It doesn't look that bad." Which also is another indicator of heightened volatility. So in any event, this tells us the market's been moderately volatile lately, a little choppier than usual. But not in chaotic territory, like when we have the VIX up in the 30s, right? Like we see when we have big sell-offs or something. And we have an occasional sell-off, but nothing earth-shattering. But for those of you who are 0DTE SPX options traders, the RV at its current level is a green light. Big green light, right? There's been enough underlying movement to fuel intraday price swings. That could spell opportunity, and we love opportunity. Well-timed trades, especially at Friday's indecisive close last week, left the market hanging, right? So we're going to keep a real sharp eye on some key levels, and we'll look at that in a little bit when we look at the volume profile. As this extra volatility could push us either above or below some of those volume nodes. And then once you get into that volume well, that low liquidity area, price could really move. Because once the shackles have been taken off, the big players, they like to move things around. See where the value is. But in any event, let's get back to the analysis. We're in the lower third of the Goldilocks zone, so we're looking at 25 to 35 wide. We go up to our big ass fly to see where it is so we can see what end of that range that we're on. So let's do that. All right, and we can see that the big ass fly is not there. Need to go to the Analyze tab. There it is. The big ass fly is below 20. All right, so that puts it into play as a solid trade. But more importantly, that will peg us on our volatility gauge, width gauge. So let's go back to that, bring that back to Trading View. And we can see that a 20 is over here, or just under 20. So that puts us on the 30 to 35 wide. So I would say that a 30 to 35 wide SPX out of the money butterfly, putting on a risk to reward where the debit is 10% or less. So we're pushing it further out, and that is because we're getting those big intraday swings and heightened movement, 30% more movement. It's a good play. And we might also look at what we call the mother of all flies. If you can find some mispricing in your out of the money fly, so for instance, you're putting on like a 35, 40 wide fly, and then you notice that one strike, all of a sudden the price drops down. Man, hop all over that. We'll talk about that more in a future episode. How the mother of all flies, another edge case strategy, has really been turning in some fantastic trades. All right, so anyways, on the way to which way, what direction? Man, this is a tough one. We're sitting here, you know, with this doji above this what appears to be a piercing candle. That's usually a pretty bullish sign. Our strategy says, hey, pick a particular way of choosing direction on any given day. And for me, it's just look at the Hull moving average, and if price is above, I go bullish. If it's below, I go bearish. But here, I'm not so sure. Where is it? Is it above or below? I mean, it looks like it's below, but it's really hard to tell. I mean, the day has just started. So, yeah, I'm going to say it's below and still go with, I know, people are going to say, hey, Ernie, can't you just see what's right in front of your, I'm sorry, right in front of your face? That's obviously below. But I don't know. To me, you know, by the end of the day, it could be above. So I say today's a coin flip. Pull out the old coin and flip it. All right? Again, it doesn't really matter because on any given day, the market is up or down, regardless of which way the trend is going. But by following this methodology of choosing a standard way of looking at our market direction, it ensures that we're more often than not on the right side of that, taking advantage of those moves that tend to be of a greater magnitude in the direction of the trend as opposed to the counter trend moves. So, but today is definitely coin flip day. All right. And that could change as we move further onto the day. We might get one of those big intraday swings that changes the whole complexion, right? All right. So let's move on. Okay, so what do we know? we know that we're 30, 35 wide. We're going to coin flip for the direction. And now we need to look at the volume structure or the market structure. All right. So this is a good example of what happens on the current day. So you can see on Friday, we moved down sharply, we moved up sharply, we moved down sharply, we moved up sharply. It's just a crazy day. And the same thing on Thursday. Bam, 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 bam. So I would say that we're probably going to expect more of the same. We're inside of a large volume node. That's where the green and the red lines, the red line is the top of the node, the green is the bottom of the node. So we've just moved over the weekend through this low liquidity area. Well, through a high liquidity area, have popped up at the top of the node. Are we going to escape into this low liquidity area? That's the question. Let's see, where is the next node? Oh, it's way up there. Maybe we can get a better look at this and do an assessment. Maybe go to a 4-hour chart. Whoa, that looks crazy. Let's get it all into perspective. Get rid of all of this chicken scratch. Turn on the nodes. And suppress that. All right, where is it all? It's thinking. There it is. All right, so we have this massive node down here that we've moved to the top, trying to break out into this rather low liquidity area, but it's really choppy. I mean, this has been a treasure trove for us, this whole area between these two nodes. Relatively low liquidity, but all of this frothiness, I guess, and there's just all kind of movement in here. So it looks like that's what we're doing again. We're trying to move up into this. I believe what we're seeing here is, well, I don't know. It's going to be fun. That's all I can say. As a 0DTE trader, things have been going fantastic for most members. Those that are new are still trying to get into the whole idea that we're really not about which way the market's going or anything like that. We're probabilistic traders. We put on small risk, keep our drawdowns low, keep our volatility of returns low, and then go after big returns. And that allows us to move up with incredible consistency. In fact, if you were to look at my Sharpe ratio of my last few accounts, it puts me into the class of the elite, but anybody can achieve that kind of return. My Sharpe ratio on my current account is at about 4.54, and my previous account was 5.87. All right, go look that up. Go find out, hey, who has a Sharpe ratio that high? I do. And so those are the type of results that you can get from trading in this asymmetric manner. You can have great returns. I mean, let's see, I'm up about 20% in the past 4 months. The previous account, I was up about 113%. My annualized, my compound annualized return is around 75%. With super low volatility, I never have a drawdown below 6%. Usually hanging around 2 or 3%. Wouldn't you like to trade like that? I know you would. I know it. And if you would like to, go down below, select the link for Join the 0DTE Academy, and you'll learn how to totally control the volatility of your returns and get great long-term consistency. All right. Yeah, well, that's about it. So I guess our opportunities, we have to turn on our opportunities for today. Go back to the 5-minute chart and see what the key levels are. It looks like 59.90 on the ES is a key level. There's a bottom of the node is at 59.34, and we have a couple of inflection points inside the node as well. So we'll be looking, if you're bullish, you'll be looking for a pullback into one of these levels. If you're, and then continue on up. If you're bearish, then you'll be looking for a pull up into one of these levels and then move down. As you can see, last week we had both. We had a pull back, and then move up, and then a pull up, and then a move down, and then a pull back, and then a move up. It was all over the place. That's what's crazy about this market, but we love it. I also found an incredible gamma breakout, or what I call a gamma scalp trade here, when we were trying to break out of the session high, and it did, and that was another nice trade. All right, so there you go. Back to the big head. Thank you very much. That's our report for this Monday. Volatility has returned, and it looks like it's going to continue. And that's all a good thing for us, us zero DTE traders. We love volatility. We love running into the fire. That's what it's like, you know. The fire is raging. We're like, yes. All right. Well, that's about it, friends. I hope you have a great trading week. Coach Ernie, out.